and you look at the data after a month and say, okay, I'm close, tweak, as opposed to going into a big data study that can take a lot of effort. And that's why the comment about standard costing is very complex for an organization. It requires a lot of labor versus FIFO, where it's going to accumulate everything and it's the actual cost of what happens.
Growing a business requires a holistic approach that extends beyond sales and marketing. This approach needs alignment among people, processes, and technologies. So if you're a business owner, operations, or finance leader looking to learn growth strategies from your peers and competitors, you're tuned into the right podcast. Welcome to the WBS Podcast, where scalable growth using business systems is our number one priority. Now, here is your host, Sam Gupta.
Hey everyone, welcome back to another episode of the WBS Podcast. I'm Sam Gupta, your host and principal consultant at digital transformation consulting firm Elevate IQ. Cost accounting is a complex topic. You have so many different choices, and sometimes it's hard to decide which method may be appropriate for your business. If you choose an incorrect accounting method, you may get a significant variance and require more admin effort to discover the source of variance and tweak the processes to reduce it. The incorrect costing method could also mean that you don't have a true sense of profitability for your products. In today's episode, we have a guest, Christiano Gherardini, who discusses the importance of costing granularity and why that is important to understand the profitability of your products. He also talks about various costing scenarios and the implications of choosing an incorrect costing method. Finally, he has had a chance to talk about multiple costing concepts, including macro and micro variance analysis, costing layers, backflushing, rework, costing concurrent, resources, and much more. Let me introduce Chris to you. Chris is an experienced Microsoft Dynamics and cloud practice owner with a demonstrated history of delivering integrated ERP and CRM solutions and leading companies through a digital transformation. Since 1994, Chris has built the business around an exclusive focus on the Microsoft Dynamics portfolio of solutions, including Dynamics 365 Finance and Supply Chain, Dynamics AX, Dynamics GP, Dynamics 365 Business Central or Dynamics NAV, Dynamics SL, and Dynamics 365 Customer Engagement. With that, let's get to the conversation. Hey, welcome to the show, Chris.
Thanks, Sam.
Of course, my pleasure. Just to kick things off, do you want to start with your personal story and current focus, Chris?
Sure. So I'm Chris Gherardini. I'm the president and owner of Turnkey Technologies. I started this company back in 1994, and after 27 years, I am a very focused Microsoft Dynamics ERP partner and implementation partner. So I'm a solutioner. So I'm a technical guy that gets to do accounting software and ERP software all day long. So it's quite pleasurable at this point in life. So.
Okay, amazing. So one of the standard questions that we have is going to be your perspective on business growth. When you think of word business growth, what does it mean to you?
Business growth, and I'm bullish. I actually have a very positive outlook, through the next 3-5 years. And you think about growth, there's a lot of different growth. There's revenue growth, there's efficiency growth, there's personnel-based growth. But I think that the markets are strong, and I think that the U.S. economy is strong, and I think it's going to support. And in our industry, we're seeing 25% standard industry growth. So that's pretty amazing stuff, but need to be bullish, in my opinion.
So let's talk about the costing. We want to get into that. Have you seen any specific growth challenges when it comes to utilizing a specific costing method and that becoming bottleneck to the business from the efficiency perspective, from the growth barrier perspective?
Sure. And I think that costing's a hot topic. And if you do it wrong, it can compromise growth, because what's that mean? Well, maybe you overprice your product. Maybe you underprice your product. So if your costing's not accurate, and again, you lose business because you're overselling, that's compromising to growth. So absolutely, costing is key to competitive advantage, in fact, to know your margins precisely, and moreover, even to know your best customers, your most profitable customers. So it's related to everything, Sam. It really is.
So if we look at the state of a business, for example, let's say if you have the management team or the CEO, they have never done manufacturing in their life, and all of a sudden they are doing manufacturing, that could be one scenario. The other scenario could be they might be doing the manufacturing on the spreadsheet, and now they are implementing an ERP system. Obviously, as you know, in case of an ERP system, things are going to be a bit organized. They'll be able to track the costing a bit more. So one of the trends that I typically see when I look at the businesses that are either on QuickBooks or spreadsheet is they would not be doing the costing the way it is supposed to be done. Sometimes they'll simply average it out and they will consume as the production cost. So what are some of the challenges that you have seen in the market for the businesses that have never either done manufacturing, or they might be coming out of either QuickBooks or spreadsheet?
I mean, it's a great challenge for those organizations because as you really analyze costing, it can get very, very granular. And when you're using manual methods, you lose a level of detail. In fact, the ability to refresh it and re-see it and see how the price of the supply chain, which is off the charts right now in terms of price increases, how that impacts costing. And right away, back to what I said, pricing. You could be committing to manufacturing at a price point, you find out that all of a sudden the product price changed or the cost changed, and your manual systems don't refresh. And I think that, as I said, granularity is it's just tough. It's tough to manually to get all that data. And we think about how are they costing? Are they in Excel with QuickBooks? They may just be doing material costing, and they may not cost labor to production, but then they may forget costs. They may forget overhead. They may forget shop charges. They may forget equipment maintenance. Oh, forgot about machine time. So there's so many cost elements. And again, as you move into a more automated system, it allows you to land them in there, to load those costs, and then refine, as opposed to have to remember everything every time. So it is compromising to have a manual costing system. And quite honestly, it's typically not going to have the level of accuracy of an automated system, where you can see changes very, very quickly. And that's imperative in the market we're in today, frankly.
Okay, amazing. So let's talk about these costing methods, right? And that is always a slightly more debatable topic, at least from my experience. So when I talk to different CFOs, different accountants, and they always debate in terms of which costing method is going to be fit for them. So describe the different costing methods that we have, and which are going to be situations in which these costing methods are going to be appropriate.
Sure, and different business systems support the standards, and some have a few advanced. But generally you'll hear about LIFO, which is last in, first out. You'll hear about FIFO, which is first in, first out. You'll hear about average costing. You'll hear about standard costing, and there's LIFO periodic and FIFO periodic, which are your LIFO standard and FIFO standard. So you're like, wow, there's 6 to choose from, and how do I pick? And a lot of people in the past used to say, ask your accountant. And some of it's based on your industry. So again, if I'm buying finished good products, I buy and I sell. Normally, people are taking a first in, first out, which means they're chronologically reducing and consuming their inventory. Some people, why would they pick LIFO? Well, they're trying to, maybe the price goes up and they're trying to reduce their margins on sales, and they're keeping higher margin potential sale products in inventory still. So again, that's a tax strategy sometimes when they're using LIFO, where they're trying not to recognize as much revenue. Average can make things simple for people. And again, if we've got high volatility, it's up, it's down. Average gives them consistent margin recognition through the different periods, as opposed to one month I made $1,000, the next month I made $10. So again, if you see that would be related to more of a perpetual, where the cost may have changed dramatically from one period to the next. Whereas average, say, hey, we made $500 in both months, right? Because the cost was $500 between the two, as opposed to $1,010, for example. And then as we get into the standard costing, again, the manufacturers, companies that use standard costing. So again, they're trying to consistently analyze, margin across what they're trying to establish as a baseline. And sometimes standard is a guess, right? And I think it's $5. And they do some math to kind of prove that up. But there's a lot of iterations to continue to refine standard cost. And again, in an automated system where you land a standard cost, and if you're granular about articulating the pieces that are in that standard cost, well, then you can even map out in even more detail to measure performance against these little cost layers and look at variances and tweak and refine. And again, there's a high degree of precision in standard costing and even analyzing variances. So again, depending on the business, again, if there's high volatility in your pricing of the products that are coming in, again, are you manufacturing versus just a distributor? So again, there's a lot of conversation around those different costing methods.
So let's take some example and some scenarios, right? So I don't know if you're going to have some stories. I'm actually going to tell you some stories, and then you can tell me whether I'm approaching this right or not. So let's say if I'm the accounting grad, okay, and I have recently graduated, all of a sudden I am hired in a manufacturing company, and they have given me an assignment that you should be running an ERP initiative. Okay, I have read these things in my school, and obviously conceptually I understand what LIFO means, what FIFO means, what average means, what standard means, but I don't necessarily have experience of setting these standards for a company. And I am working in a manufacturing shop, and this manufacturing shop is a food manufacturer. I spoke to a bunch of friends, and those friends told me that LIFO is an appropriate method, the costing method for me. What will be your perspective on this? Am I choosing the right method?
And honestly, LIFO is one of the least popular costing methods that I've seen in implementations, frankly, because last in, first out, which means you're leaving old inventory on the shelf. Well, okay, if there's not an obsolescence factor to your inventory, maybe that's not a big deal. But certainly you're leaving what would be perceived as the least cost items still sitting on the shelf because we expect the prices have gone up more recently. So what we're doing is we're not recognizing as much margin. Okay, well, again, it depends on the business, and maybe they're profitable and we don't want as much revenue to be recognized. But that would be my first reaction to a LIFO suggestion, and trying to understand is what was the rationale for that based on ownership. If the accountant says, oh, no, I think this is the best choice, and again, I'd have to ask about the supply chain side and understanding, well, what's the characteristic of the materials, the raw materials being purchased? And again, is there volatility? Has there been a continuous increase over time? That's influencing that decision. But normally my first thought is they're trying to keep some lower cost items in inventory and again, not get revenue hits, for example.
So what would be your recommendation? And can you tell me a little bit about which method is going to be appropriate for me so that I can go back to my accountant and the management and tell them that, you know what you were thinking from the LIFO perspective is absolutely incorrect. And you guys probably should be thinking about either average or FIFO or whatever. So tell me, which method would you recommend? If you have any questions about my business, I'm more than happy to answer for you.
Sure. And again, the selection of a costing method, normally I inherit that, but I would be leaning more towards a FIFO. And a lot of times, unless it's a mature business that really understands their costs, approaching standard costing is difficult because standard costing expects that you have an Excel spreadsheet that articulates materials, labor, routings, operations. And so again, the more mature of an organization, the more likely they are to head towards standard costing. The less mature, FIFO, first in, first out. Again, we're chronologically consuming inventory. And again, in that manner, manufacturing is going to be showing actual costing. So again, we still have to kind of understand pricing ambitions and margin ambitions, whether pricing does vary on a cost plus basis, whether there's contracts in play. Again, the standard costing would align more to a more established contract prices because we'd have consistent margin recognition per period based on prices established. Whereas, again, as you're hearing me with a FIFO or even a LIFO perpetual, we could have high variances in cost compared to a static price point. So is pricing static? Is pricing flexible? Is it cost plus pricing? I guess that's a question that I would ask you there because pricing can influence what I would recommend in terms of margin recognition.
So in this particular case, this is a pet food business, right? So we are actually selling the consumer packaged good for pets. So we don't really have as such the price variability, I guess, just because the kind of ingredients that we are using, it's just meat and, couple of flavorings. So for the most part, I mean, the price is fairly standard just because we have our vendors that we work with all the time and they don't really vary the prices as much. So obviously the prices don't vary as much either. So would you be leaning more towards FIFO in this particular case? Is that your recommendation?
I think we're going to be leaning toward FIFO. And again, if the organization is many years old and has a large staff, then they can probably take on a more complex costing method because that's what that would be. Is there'd be more labor involved in doing a standard costing, recommending in organizations.
Okay, amazing. So let's take another scenario here. Okay, so we have one more business. It's the electronic business now. In this particular case, we are carrying bunch of products. Some are going to be things like your keyboard, but we also have the batteries that have the shelf life. Okay, so we have different product mix. So which costing method would you recommend here in the electronic business and why?
And I still think that FIFO is going to be the lowest maintenance around inventory. So I think that's another one of those attributes. But again, we're moving out the oldest inventory. And certainly in electronics, we don't want to get stuck with obsolescence. So I think that would be a concern is to make sure we're moving the oldest inventory out of the system.
Would you recommend more tracking the accounting method at the product mix level? Or do you recommend that shall we generalize it as the FIFO as the generalized method for all the products? Or can I do, let's say, battery as FIFO because they have the shelf life, but my mouse or keyboard, they don't really have shelf life as such. So would you do it at the product mix level, or would you do it at the generalized level?
I think you generally pick a costing method for the company, but as you're indicating, you can have different costing methods for different products. And again, as you think about manufacturers, if they're mature, they're going to like standard costing more because they can really more precisely track variances and try to refine those efficiencies. And FIFO is going to be a low overhead costing method for an organization. And again, whether it's keyboards, whether it's mice, whether it's, again, as you think about foods, it's very applicable to that.
Yeah, it does. So let's take one more example. And I don't know if you are going to have any stories, and you can share your stories as well. If you have seen any costing methods where they were used incorrectly and the kind of problems you had. So I'm going to propose one more example here, and maybe you can share your recommendations. So now This is a lumber business, okay? In this, what they are trying to do is they have a lot of lumber that actually comes to the yard, and then they have to track the costing of the lumber. So in this particular case, would you still recommend FIFO? Do you recommend average, standard, or LIFO?
Yeah, and so here's what gets above that. If we're lot tracking, for example, if I have a lot of lumber that I purchase, and let's say I'm still picking FIFO, even within a FIFO mechanism, I can still have a lot of inventory, and that lot would have a specific cost even within those FIFO layers. I can go sell that lot of lumber, and actually the cost for that lot travels with it. So that's a pretty precise caveat within a costing method. So yeah, I'm still standing by a FIFO perpetual being a low overhead costing method, and moreover in the lumber industry, I think we're going to be looking at lots because I can assign cost to a lot of lumber that I receive, and then when I sell that lot to a specific customer, I can price it accordingly because that cost travels with the lot, and if I'm pricing it, I'm very specifically able to articulate my margin at the point of the transaction, as opposed to it randomly shows up. So again, I have visibility of the cost of that lot within that FIFO layer. I attach that lot to my sale transaction. That's the cost that goes with the price that I establish for that transaction. So it's a very predictable margin scenario.
Okay, so now let's talk about some of those costing details, right? And in some cases, when we go across the, let's say, manufacturing shops, some manufacturing shops track these costs at a very deep level, meaning they are going to have, let's say, 600 different chart of accounts, and then it's going to be extremely verbose in terms of the kind of cost they are tracking. But some are going to be slightly more concise, right? So what is your recommendation in terms of what are the key details that manufacturers should be tracking? Do these details vary across the micro verticals? For example, let's say if I go from the electronics manufacturer to automotive manufacturer to, let's say, aerospace manufacturer, do these costing details vary?
Well, I think that they're going to be applicable to all businesses. And the question is whether every business plans and manages and tries to rationalize those costs. And if I use the examples where, even as you asked about general ledger and chart of accounts, do you need 600 accounts? Not necessarily, but in the costing categories, you typically are seeing 3 different cost layers for material, 3 for labor, 3 for machining. And what are you talking about on material? Most people think it's just the price you pay for your vendor, but there's actually, in a standard costing model, we can have that material cost, and then we can also have a fixed overhead. What's that mean? Well, I'm figuring out a cost for that warehouse, and then I can have a variable overhead for material, which could be my warehouse labor. So again, in the material costing, I want to track what's the material cost, well, what's my facilities, and what's my warehouse labor. Now let's talk about production labor. Great. Now I've got production labor. I've got a cost for wages, and then I'm going to have fixed overhead for that worker, could be his benefits, and I could have some variable overhead for that worker. Same conversation on machining. I've got a fixed cost to operate the machine, and then I've got some variable overhead and some fixed overhead because, again, what am I factoring in there? I'm factoring maintenance and repair. And so, in essence, those 9 categories of costing between material, labor, and machining gives me the granularity to allocate 100% of the costs related to material, warehouse personnel, shop floor workers, machines, all of those costs. So now we identify those 9 different categories. And again, not everybody's trying to allocate overhead to material. But again, if we really get granular, we really want to do 100% of it. Those are the 9 categories. And as we flip to the general ledger, well, now we need matching accounts for those 9 different levels. And the different categories that we would think about is variance. Oh, okay. So I need variance for material overhead, fixed and variable, variance for labor. So we end up with a variance category for those nine categories. And then we have a WIP, work in process, right? Because at any point in time, I want to say, well, how much labor do I have in WIP? Okay. Well, how much labor overhead do I have in WIP? And so again, the visibility into the variance of labor, the WIP of labor. And then the next category is finished goods inventory. Because again, if I'm doing all these different layers of costing and I have a $10 million in balance sheet inventory, that, somebody might say, well, how much of that 10 million in balance sheet inventory is labor versus material versus overhead versus, right? And in the end of the day, when I sell those products out of inventory, it ends up in cost of goods. I can have that same level of granularity if I wanted to see, well, out of that cost of goods number, instead of seeing one number, do I see how much of that cost of goods is really related to material overhead? And in the end of the day, there's even another application of accounts called the applied accounts, meaning, the bookings against these actually act as contra expenses. So if you think about the P&L, and not to get too technical, but in the profit and loss statement, I've got a line item in there for shop wages that comes from ADP. Well, I've got a line item right next to it. It's called wages applied to manufacturing, which the ADP is a debit, right? I got 100,000 in wages. Well, the credit entry comes when I start executing manufacturing routings, right? It's crediting $100 in labor for an hour of this guy's time, and where's the debit go? The debit goes to work in process. So what happens at the end of the day at a period level is I see, wow, I had 100,000 in wages and I applied 90,000 to manufacturing. What's that mean? Well, it means my standards are too low, right? I didn't absorb all my labor in production. So that's a macro variance analysis. But again, as we talked about those 9 different categories of cost and the granular and the general ledger accounts, they'll give you that purview on, okay, where's my problem at? My labor standards too low? Oh, they're too high. What if I had 100,000 in wages and I absorbed 150,000 in wages? Oh, that's a problem too, right? And so what does that mean? My costs are wrong. And there's a whole lot of related analysis that can come by looking at that delta between the actual expense and the amount of it that's absorbed through the manufacturing process. So getting granular, but like I said, that's the degree that you can go to. And what you're trying to do is you're trying to find exceptions. You're absolutely trying to find the exceptions and remediate those. And the next month, guess what? Hey, no variance. That's certainly where we want to end up.
Yeah. So when we look at these cost categories, and you did mention that we have roughly 3 for material, 3 for labor, and 3 for machines as well, right? So when, let's say, if I'm doing this for the first time, it could get fairly confusing. Okay, which one is going to be my fixed? Which one is going to be my variable? So what is going to be the guiding factor here to decide, okay, which are my fixed category, which are my variable category, so I don't end up mixing them?
That's right. And it's crawl, walk, run is what I'm going to tell you, that most companies climb in and we see a lot of them, their costing is just material costing. Well, that's not accurate enough, right? But typically, and one of the challenges with standard costing is I don't know how long it takes, which means what? Do they have to start collecting data? And there is data studies that help you derive accurate standards, and even as we put routings on manufacturing. But there's always a starting point is what I would say. And as you look at costing, you don't have to attack the entire, you start with one product. Maybe you have one bill of material, one production. It's 80% of your business. Guess what? We start there. And again, there's a crawl, walk, run. You don't have to deal with fixed and variable overheads initially. Maybe you guess at it and you look at the data after a month and say, okay, I'm close, tweak, as opposed to going into a big data study that can take a lot of effort. And that's why the comment about standard costing is very complex for organization. It requires a lot of labor versus FIFO, where it's going to accumulate everything and it's the actual cost of what happened. So, but again, there's a crawl approach in there. You don't have to jump in and use all those, but some accountants will know. They're like, okay, roughly I got $100,000 in warehouse. Okay, I divide that by what? How many deals do I do, or how much this? You divide it, you come up with some amount and you plug it in, and then there's a point where you're measuring how close am I. And refinements will collapse the variance. And again, there's a point where you say, I'm within 3%. That's enough. So again, it's the 80-20 rule. You're really trying to find the exceptions and remediate those. And like I said, even as material, as we talk about standards, all I'm doing is getting a macro variance on material. I don't see where the problem's at. Wow, I'm off by $1 million. Well, where's the $1 million? I don't know, because I didn't track it. So now you bring in just a whole nother category of data collection. So if you think about, well, how do I know that's the right material? It said 5, I used 5. I went and counted. I'm short in stock. Did somebody grab 7 instead of 5? So there's same with labor. I thought that it takes 5 hours. Well, why do I have twice the cost in labor? Did he take 10 hours? Which job took 10 hours, right? Why did he use 7? Did he break 2? What happened? And so as you hear that second set of questions to really pinpoint variances, that's the next degree of costing, where now we have a standard that said 5 hours, but I have the worker, he clocks in, he clocks out. Hey, guess what? He took 5 hours. Oh, hey, guess what? He took 12 hours. I got a problem, right? And every time he did it, it's been 12, 12, 12. So as we take that next step, right? I said crawl, walk, run as we go into data collection. And even in that context, I don't have to do that for everything I make. Same thing on material. I said, it says 5. Do you go in and scan 5? I don't have to scan everything. There's some of them it's predictable. But if Maybe he's using gold as part of the process. Guess what? I want him to clock out how much gold he takes for the job.
Yeah, for sure.
And again, if he breaks something, he's going to have to scan out more of it so that I know what happened here. Well, I spilled something. Okay, that answers that question as opposed to thinking we have a systemic problem. It's the same thing on labor collection. Maybe you do it on one particular type of thing you produce because it's the most important, you sell the most, and guess what? Once you figure out how much time it takes, you adjust your standards, you're reducing those variances. And so a number of different techniques to kind of crawl into this incrementally, depending on what you're trying to fix or find out what's going on. And sometimes people just can't tell. They make money, but they don't know where they're losing money is the point. It's a blur.
Okay, since you mentioned the macro variance analysis, so I don't know how that works. Can you touch a little bit on that? And do you have anything called micro variance analysis by any chance?
Sure. Yes. So it's a great question. So what we originally started talking about is what's macro, where I'm looking at the profit and loss statement and I see my 100,000 in wages and I absorbed 80,000 into by manufacturing. You're like, that's macro. It says 20 grand. Wow. I don't know where I'm wrong. I don't know which of my productions is high and which one's low. I could have some that are high, some that are low, and the net difference is 20,000. So that's macro analysis. And I think the other example of macro analysis is variance analysis is I do a physical inventory. At the end of the month, I'm off by $1 million. Well, I have no idea what happened. And so that's macro. And, again, if we don't issue material against a manufacturing order, meaning it says, hey, it says take 10 pounds. I assume he used 10. I consume 10. I go count and I'm off. I don't know. And again, that step forward, when we have these big variances, I need to start having this guy check out how many pounds he takes. It said 10, he took 10, he came back, got 10 more. Okay, I need to record that. And then now we get micro variance, which means on a production order basis, I can look at the variance at a production order. And then I can get very, very precise. And moreover, if we're collecting labor by a worker, I can tell that this guy only makes 3 widgets a day and the other workers make 10. That's an example of a micro variance analysis. And is it costing? It's costing, it's performance. And so there's a lot of those micros. And again, inventory variance. Where am I losing product? Where is my labor assumptions off? Where did he have more machine time than he should have? Why did that happen? So again, in the CFO and the owners, we want those answers because, again, if we can't see the exceptions, we can't refine that. And like I said, overall, we're profitable, but we may be losing money on some, and we need to see that. So that's the example. Macro, you're seeing it on the P&L. Micro, you're down at the production level where I can see it for a specific product run. I can see it by worker. I can see it by a machine. Again, maybe I'm kicking out defects, so I'm tracking good and bad. And, hey, that's important to know that something's not right. And so, again, as we get to that next level of detail, that's where we really get to solve the problems. So, and it doesn't happen on day one.
Amazing. So let's talk about the labor issues. And typically when we look at the costing, I guess, from my experience, the costing for the material is going to be slightly easier, but it gets really complex when we look into labor issues, right? Especially when it comes to scheduling for labor. Let's say if one resource is working on multiple machines, or if we are looking at the actual utilization of labor across the jobs, sometimes those problems could be challenging because let's say if one person is working on a specific job and then he or she has to move out because she or he has some sort of emergency and then another person comes in. So how do you keep track of all of this and how do you accommodate the rate changes? Let's say if you are shifting from one worker to the next, how do you accommodate all of these things into costing?
It gets tricky, and I think that's where as you have standards on a bill of material, a standard routing and a standard labor and a generic worker, okay, that doesn't really give you what you need. But typically what people will do is they'll set up labor codes to represent the different, let's call them tiers of cost for workers, as opposed to the degree where every worker has a regular and an overtime cost code. And you can go to that degree where every worker has that and it agrees with what's on there is their salary. So that's the nth degree is you have a labor code for every worker. And again, as they clock in and clock out, and again, you have to get the clocking because if you're not collecting the individual time against the production, it's generic, right? It's a standard, and there's not going to be any variability because it's not just going to substitute a pay or a labor code when someone changes. But if somebody is clocking in, clocking out, and there's a labor code that's assigned to them that may be assigned to that operation, it gets very specific. It pulls in a very precise labor rate. And so if somebody clocks in, somebody else clocks in, we've got 2 different labor rates. I have a supervisor, I have a junior, I have a senior, I can have a senior engineer, I can have lots of different positions. And sometimes, again, are the rates based on position? Are they based on the individual? But again, as different people clock in and clock out of production, we're aggregating all these various costs at that level of detail. So, techniques, and we go back to hey, he's running 2 machines at once. Well, again, will the system let them log into two jobs at once? Some systems won't let you clock in twice. I said, oh, you already clocked in, run it over there. So what happens? Does he get two identities? There's people that'll set up two identities for an individual. But then it's interesting. Is he always concurrent, which means are those two identities at half rate, or do I have two at full rate and two at half rate, and I log in, use the appropriate one? So it adds complexity when people are running multiple jobs. And there's a different technique of costing that job than the standard one. And it goes the other way where, wait, I've got three people working on this one. So now you have three workers. And again, how do I cost them? So again, we're aggregating. And some systems do have the capability of knowing how many people are on the crew. Sometimes you're just adding multiple people are clocking in on the operation. And then the actual labor is much more precise than what you can articulate in the standard routing.
Okay, so let's talk about routing. So let's talk about some of the older ERP systems. And I don't know if you have seen some of the older ones where they didn't really have the routing just because they could not support that kind of sophistication because technology was limited back in the day. So a lot of manufacturing companies still use those ERP systems, and the way their implementation look or appear is for each of the operations on the routing, they are going to have or they are going to divide that individual job order. Okay, so for each of the operations, they are going to have 5 different jobs. So in the modern ERP systems nowadays, I mean, they can support all of your detailed routing, right? So you are not going to have multiple bombs, you are not going to have multiple job orders. But in the older ones, you had the individual job orders for each of the operations. So let's say if a manufacturer is there who's still using that older ERP system and they don't really have detailed routing system and they feel that I'm actually trying to show them new ERP system and I'm actually trying to coach them that, okay, this is how the modern ERP system is done, but they are thinking that my processes are unique. Okay, and maybe you are not able to support the way my processes are constructed or built. What will be your recommendation for this manufacturer? Are they approaching this right by creating the individual job order for each of the operations in the manufacturing process? What are going to be implications if they keep doing that?
Yeah, and I think that's an interesting perspective. Is again, if we're stuck on a legacy system and we can't upgrade, you're creating a workaround. I mean, there's not a perfect answer, and without knowing what the specific system is, but whether you have the granularity of 3 cost buckets for material or you load it all into one, again, the accountant's going to have a manual way to parse that out. In terms of being convinced that there's not a system that can accommodate the manufacturing, I'll say this: discrete, process, mixed mode, engineer to order, configure to order, build to stock, integrated from a CAD PLM system that automatically generates bombs and routings. All that capability sophistication is in the market. And I think that even parametric configurator. So I think there's a lot of people who be pleasantly surprised as to how much the technology has evolved. And I think that to take a fresh look, because honestly, I use the tagline, empowering competitive advantage. And frankly, if your costing's wrong and your system is limiting you, you're not competitive. And I think most businesses are recognizing that, great, but they can still get accurate costing out of a legacy system. They're just going to have to create a workaround. And like I said, whether there's any supplements, but that's the best answer I get on legacy if they can't get off of it.
Okay, so let's talk about one more scenario. And you seem to be emphasizing how important it is to issue the right material, especially if they are going to be expensive. You also emphasized during this conversation how important it is to clock in and clock out to be able to accurately cost. Now, I am talking about one of the manufacturers, and again, they were using very simple ERP system. In their case, I don't know which ERP system was that, to be honest, but I mean, they didn't have as much admin effort. For them, they felt that, clocking in, clocking out is going to create additional work for the production floor. They felt that the material issue should be completely automated. There should not be any step of material issue. There should not be any step of labor reporting. If you were to coach or advise to this management team, do you agree with this approach? Would you question this approach? What will be your recommendation in this?
And again, I'm smiling because it depends on the business. And to your point is maybe their bill of materials and their assemblies are pretty predictable and they don't have to count, they don't have to issue material. So the technique they're using is called backflushing. Again, whether they backflush on the front end, backflush on the back end, a lot of people use backflushing because a lot of them aren't manufacturing the raw materials into component parts. They're not grinding, welding, Maybe they're taking a bunch of pieces and they put them all together into an assembly. Hey, it's still manufacturing. There's still labor. There's still operations. But again, the material issue piece maybe it's pretty straightforward. And maybe they don't have that. I talked to a group today that rework. Rework means you continue to issue more and more material that was beyond the original specification. So again, based on the business, based on the products they're manufacturing, a backflush is fine. And honestly, we go back to that macro labor variance. The CFO may say, man, I got this. I absorb it all. I don't need to figure out, or some high, some low. At the end of the day, maybe they're overtly profitable. And guess what? They're right. To make people clock data doesn't take them anywhere better. But there are other people that are in more competitive situations that need that precision. And 4 percentage points on price can cause them to lose. And if that 4% is artificially inflated due to inaccurate cost, and again, it's back to everybody has a different feel for. Some people have it nailed. They know their costs. They instinctively know it, and they're making a ton of money. And guess what? The cost of implementation, the cost of data collection, or even mobile devices in a warehouse, it doesn't appeal to them. It could also be an old school head. We've got new breed, old breed, and again, we're seeing a lot of change in the guard and mobility in the warehouse, and to be able to elegantly have work move and have even transfer orders or quality orders and have those things elegantly show up on a worker's device so he knows what work he should be doing. That's the new world. That's the new expectation. But there's a lot of people that still don't, I'm making a ton of money. I don't need to do that. And sure, they don't. Okay. And again, they're going to be profitable, but it's, how much more profitable could they be? There's the real question. And they don't know. They can't quantify that, because they believe that I'm as good as it's going to get. And like I said, case by case. So you can't argue with people if they're convinced, but there are other people that want a better way. They want to be competitive. They want to refine, and they want to compete. And those are the ones that absolutely are going to implement these types of features incrementally. And again, where it makes sense, right? We don't touch everything, but we want to chase the stuff that really can make a difference. As I said, you got one product you're doing 80% of your revenue on, boy, you sure want to make sure that you're right on that one, frankly.
Great. Since you mentioned the term backflushing, and a lot of my listeners might not be familiar with that term. So what is backflushing? That is number one. And number two, in which situations is it going to be appropriate to use backflushing?
Yeah, and again, it's still back to the predictability of the assembly. And again, a backflush means you take the recipe and you use it verbatim. It'd be like opening up a cake mix that has the eggs and the butter and the oil and everything in there. You dump the whole thing in the bowl. Done. I don't go get anything else. I don't go, it asked for 2 eggs, I put 3 in. Well, you put 3 in, you're not backflushing. You're doing a additional material issue. But that's what backflush means. It means consume the materials on the bill of material as written. So it takes the standard recipe, it consumes the standard recipe. There is 0 variance at the production order, is what that means. You don't collect labor, there's 0 variance at the production order. Production order looks, hey, I executed to the recipe. I think you don't really know. And you can't substantiate that. So
okay, amazing. That's it for today, Chris. Do you have any last-minute closing thoughts?
Like I said, any company that wants to take their game up and get more efficient in manufacturing and be more competitive, we'll love to help. So lots of opportunity out there for companies to do more. And the expectations of people are just that we are rising to the occasion with better technology to track those costs, to be efficient, to manage. That's it, Sam. Thank you.
Okay, amazing. So my personal takeaway from this conversation is going to be costing has far more implications on your business. It's going to have on your profitability as well. So understand your costing and do it right. So on that note, Chris, I want to thank you for your time. Really appreciate your insight.
Appreciate it, Sam. Thanks for having me on.
I cannot thank our guests enough for coming on the show, for sharing their knowledge and journey. I always pick up learnings from our guests, and hopefully you learned something new today. If you want to learn more about Chris, head over to turnkeytech.com. It's turnkeytec.com. Links and more information will also be available in the show notes. If anything in this podcast resonated with you and your business, you might want to check other related episodes, including the interview with Ram Krishnamurthy, who discusses costing strategies for different businesses and why that matters for ERP implementations. Also, the interview with Brian Sommer, who discusses why legacy ERP systems and artificial accounting practices need to change with time. Also, don't forget to subscribe and spread the word among folks with similar backgrounds. If you have any questions or comments about the show, please review and rate us on your favorite podcasting platform or DM me on any social channels. I'll try my best to respond personally and make sure you get help. Thank you, and I hope to catch you on the next episode of the WBS Podcast.
Thank you for listening to another episode of the WBS Podcast. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. For more information on growth strategies for SMBs using ERP and digital transformation, check out our community at WBS.rocks. We'll see you next time.